Hello. Welcome to our teleconferencing program. Good morning to all our regional directors, staff members and viewers across the country. We wish you all a happy and prosperous new year. Today we have 3 sessions. Our first session will be up to 11:45 on sources of capital funds. Our next session will be from 12 to 12:45 on employment of funds, and our third session will be from 1 to 1:45 on the other sources of funds. To begin with, in this session we'll have a presentation. If you have any questions related to this session, you can keep sending us. Our toll-free number will be displayed for you on the screen during the session. As you all know, finance is the study of money, its nature, creation, behavior, regulations and administration. Therefore, a system including all these activities dealing in finance and organized into a system is a financial system. Thus, the term financial system implies a set of complex and closely connected or intermixed instructions, agents, practices, markets, transactions, claims and liabilities in the economy. The financial system plays a crucial role in the functioning of the economy as it allows transfer of resources from savers to investors. This system consists of financial institutions, financial markets, financial instruments and financial services. Financial institutions mobilize and transfer the savings of funds from surplus units to deficit units, and the place or mechanism where funds or savings are transferred from surplus units to deficit units are the financial markets. The financial markets can be classified as money markets and capital markets. Actually, the money markets are markets which deal with short-term claims of financial assets which mature within a year, whereas the capital markets deal with long-term claims or financial assets which have a maturity period beyond a year. In addition to this basic role of allowing the flow of capital from surplus units to deficit units, the financial system is also expected to ensure a frictionless flow of capital at lowest cost. The objective of financial management, whether it's a manufacturing or a service or a banking industry, the basic objective of financial management remains the same. It's all about raising money, putting the same to optimum use and managing liquidity and risk of the business units. Since banks handle a large volume of money, financial management is central of the whole activity. The Treasury Division or the department of any banking unit plans and monitors all financial movements. It plans for the fundraising, fund deployment and managing liquidity and risk. Every organization needs finance to accomplish its mission or vision. This fund is raised either directly from investors or through intermediary institutions like banks. There are various sources from which these organizations can raise the funds, and these different sources are what we are going to discuss in this particular session. That is, the sources of capital funds will be discussed, and to discuss on this topic we have with us a very eminent person from the area of finance, Professor P.N. Varshney. We welcome you to this session, sir. Professor Varshney has been with the Delhi University for more than 2 decades, and he has a number of research papers and books in finance and also in banking. So I hope that you will be able to make the best use of the expertise that we have with us in our studio, and with this I would like to hand over this session to Professor Varshney. Welcome.
Friends, I propose to talk to you on the importance of owned funds in banks and the measures which have been taken in recent years to augment these capital funds. Needless to say that owned funds, that is the owner's funds, are very significant to any business organization, not only to banking organization. Owned funds provide a sort of cushion to the creditors, long-term or short-term creditors of the business unit, and hence in every business organization we find that the owners are required to put in their own contribution towards the funds. These funds are called owned funds. Apart from the owner's contribution in the form of equity, the organizations are required to plow back their profits also, that is, they retain their earnings also in the form of reserves. We find in case of the banks that these two provisions have been maintained or mentioned in the relevant laws also. Firstly, I would like to tell you that in case of the trading and manufacturing organizations, there is great significance of debt-equity ratio, that the debt should not exceed a number of times the equity of the firm. That is 2:1 or 3:1. These are the ratios are supposed to be as satisfactory ratios, keeping in view the nature of the business. In the banking business, because banks largely depend on the borrowed resources, or rather we can say borrowed resources are the raw material which they transform into final product like loans and advances. Therefore, such a strict ratio 1:2, 2:1 or 3:1 cannot be maintained here. Yet, efforts have been made in recent years to augment the capital resources. In the beginning, when the Banking Regulation Act was enacted in 1949, minimum capital requirement, paid up capital requirement was mentioned or was incorporated in section 11 of the Act. Those provisions prescribed only 1 lakh of rupees or 2 lakhs of rupees or 5 lakhs of rupees according to the nature, the nature of the place or the location of the business of the bank concerned. Even the Reserve Bank of India, when it was established in the year 1935, its paid up capital was prescribed at rupees 5 crores, and it still continues at rupees 5 crores. So many banks, in the case of the banks also, you find that the old banks are having lower capital, because whatever capital has been prescribed under the Act, they have fulfilled the requirement, and they are contributing to capital funds through the reserves. When new private sector banks were permitted in the 90s, an effort was made to prescribe a much higher minimum capital requirement. That is, in the first guidelines for private sector banks, 200 crores were prescribed as the minimum requirement. In the revised guidelines, this was enhanced to 300 crores, including the reserves. In this, we find that a higher requirement was prescribed for the new private sector banks. In the case of the nationalized banks, when they were nationalized, whatever was their paid up capital, the entire paid up capital was taken over by the government, and that continued for some time. The Nationalization Acts were amended in 1994, and this prescribed the authorized capital can go up to 1,500 crores, may further go to up to 3,000 crores. The capital can be refunded to the government also. All these measures were included in the Nationalization Act amendment made in the Nationalization Act in 1994. But one proviso was added, that the capital held by the government will not go down below 51% of the total paid up capital of the bank, and rest of the capital, that is up to 49% of the capital, can be issued to the public also. In accordance with this amendment, we find that many banks, public sector banks, issued capital to the public, and some of the banks have got public participation as high as about 49%, or we can say 40% to 49%. Recently, the Nationalization Acts of 1970 and 80 have been amended in the year 2006, which has come into force on 5th of September 2006. This Amendment Act has permitted the banks, nationalized banks, to issue preference shares on a preferential allotment basis, private placement basis, or public issue basis. But the share of the government in the equity capital will not go down below 51%. Preference shareholders will have voting rights only in those matters which affect their own interest and not in other matters. And here also, each preference shareholder shall have the maximum voting right of 1% of the total voting rights of all the preference shareholders. It means that the government stake is to be retained at 51%. Preference shares can be issued in addition to the equity shares, and equity shareholders will not have the voting rights on matters relating to the general management of the banks. Only their own interest can be debated upon and voted upon by them. Similarly, a bill has been introduced in Parliament recently in December, which intends to raise the authorized capital of the State Bank of India from 1,000 crores to 5,000 crores. And it also provides that the Reserve Bank of India's minimum shareholding can be reduced from 55% to 51%, which is at present about 60%. You know that Reserve Bank of India's major shares are held by the Reserve Bank of India and not by the Government of India. And the requirement is 55% should be held by the government. So the Amendment Act, Amendment Bill, which has been introduced in Parliament, prescribe two things. Government share, the Reserve Bank share can come down to 51%, and the share capital can be increased to 5,000 crores. Preference shares can also be issued by the State Bank of India, but the voting rights will be kept at 10%. Reserve Bank of India, the State Bank of India can issue to the public the excess holding by the Reserve Bank of India also. That is about 9% excess holding, over 51% can be issued to the government to the public, and in this way the shares can be held, can be offered to the public. It is also reported in the press that the State Bank of India is also intending to enter into the capital market after this amendment takes place. So in this way we find that efforts have been made to augment the capital funds, that is the equity capital, also the preference capital in case of the nationalized banks, in case of the private sector banks, and in case of the State Bank of India. Let me cite the efforts which have been made so far. In the year 2005 and 6, scheduled commercial banks, both public sector and private sector, raised large amount of resources from domestic and international capital markets to strengthen their capital funds. In case of the nationalized banks, in the year 5 and 6, 5,413 crores were raised from the capital market in the form of equity, which was 24% higher than the previous year. In 4 and 5, 3,300 crores of rupees were raised. In 3 and 4, 1,100 crores of rupees were raised. So we find that in each successive year, nationalized banks have been raising funds from the capital market to a larger extent. These amounts are inclusive of the premium. You will be surprised to know that larger amount was in terms of the premium. Face value of the shares were just 218 crores, and the premium which was charged from the investors was 5,436 crores. It means bank shares are quite popular among the investors, and banks have taken full advantage of charging the premium, higher premium. Just 218 crores that was the face value, and 5,400 crores was charged as premium. In the case of the private sector banks, we find the same story. In this year, 5 and 6, 5,654 crores were issued in terms of the equity shares. Face value was just 218 crores, and premium charge was again 5,436 crores. And this was largely due to the fact that the leading bank in the private sector, ICICI Bank Limited, charged a premium of 5,003 crores on the face value of 98 crores. So, these figures clearly speak that our banks have made the effort to enter into the capital market, and they have tried to avail of the opportunity of charging premium because of their sound financial position, or we can say larger profitability. In this way, we find that the shareholding pattern in the public sector banks is largely in favor of the public. There are 11 public sector banks in which the public holding, the general public holding is between 40% and 49%. That is a little below the permissible limit. And there are just 4 banks where it is less than 10%. That is 90% or more than 90% of the shares are still held by the government. Foreign financial institutions are also interested in Indian banking system. At the end of March 2006, 20 Indian banks shareholdings were held by foreigners, by the financial institutions abroad. So in this way, what we find is that the financial institutions, the banking financial institutions, especially the public sector banks, are raising resources in the form of equity from the market to a larger extent. Prior to all these developments in the last decade, Government of India provided equity support to these banks. At that time, it was not possible for them to raise funds in the market because their financial position was not very sound. Banks were not earning sufficient profits, and it was not possible to enter into the market. And also because the Act was amended in 1994. Prior to that, 7% ownership was vested in the central government. So in this way, we find that banks have tried to raise capital funds not only from the government but also from the capital market. In case of the State Bank of India, there was public issue of State Bank shares, and the ownership of the State Bank of the Reserve Bank of India came down from about 90% to about 60%. So this gap was filled by public issues. Here, I would like to mention the capital to risk weighted assets requirement or ratio prescribed by the Reserve Bank of India, capital adequacy norms. In early 90s, Reserve Bank of India introduced these norms in accordance with the what is called Basel Accord. International Bank of Resettlement introduced this, and many countries have followed. At present, the requirement is that the capital funds of the bank must be 9%, at least 9% of the risk-weighted assets on an ongoing basis. Now, let me explain what is this capital adequacy norm. You know, in this norm, The capital is divided into two parts, two categories, Tier 1 capital and Tier 2 capital. Tier 1 capital is the core capital, or we can say the permanent capital, which is basic capital to the bank. It comprises of the paid up capital, statutory reserves and other disclosed reserves, and capital reserves, as reduced by equity, investment in subsidiaries, intangible assets and losses past and present. This is the Tier 1 capital. Tier 2 capital, which is called subsidiary or subordinate capital to Tier 1, comprises of undisclosed reserves, that is the hidden reserves, and cumulative perpetual preference shares. Revaluation reserves at a discount of 55%. That is, the face value of the revaluation reserve is not taken into account, but it is discounted, and only 45% is taken into account as the Tier 2 capital. Then general provisions. Fourth, hybrid debt capital instruments and subordinated debt up to 50% of Tier 1 capital. Now, a ratio is to be maintained between these two categories of capital. Tier 2 capital should not exceed 100% of Tier 1 capital. That is, if the entire capital 9% is to maintain, at least 50% must be maintained in capital 1, 50% in capital 2. Tier 2 can increase beyond 50%, but Tier 1 can exceed the 50% limit. It can be up to 90%, 80%, but Tier 2 should not exceed 50% of the total capital. According to the Reserve Bank's latest report on trend and progress of banking, composition of CRAR at the end of March 2006 was as follows. Total capital funds were of 2,21,000 crores rupees, I am rounding up the figures, which comprised of Tier 1 capital 166,538,000 crores, 38 crores, including paid up capital 25,142 crores and reserves 1,41,592 crores. In this way, we find that Tier 1 capital constituted 90.3% of the risk adjusted assets. Tier 2 capital largely consisted of subordinated debt, that is 43,214. In this way, the risk-weighted assets were of 17,97,000 crores of rupees, of which risk-weighted loans and advances were 12,38,000 crores of rupees. And when we compare this risk-weighted assets to the capital funds, to total capital funds, we find capital adequacy ratio of 12.3%. Now, you will appreciate that while the requirement is of 9% capital adequacy, our banks were having capital adequacy of 12.3%. That is much higher than the required minimum. Second point to note is that the first component, Tier 1 capital, far exceeds Tier 2 capital. It implies that there is more headroom for raising capital funds through Tier 2 route. That is, the capital can be raised equal to Tier 1. This 3% of the total funds can be raised up to 9% also. Just like Tier 1, it can be raised up to Tier 1 also. 78 banks had the CRAR above 10%. When we say that 12% is the total for all the banks, 78 banks were having more than 10%. Only few banks were having CRAR lower than 10%. In this way, I think you will appreciate that our banks are fulfilling the requirement of the Reserve Bank of India to have capital adequacy ratio of 9%. You will also appreciate this point that they are fulfilling this requirement largely through the reserves. 1,41,000 crores of rupees is the amount of the reserves which they have accumulated over the years as against paid up capital of just 25,000 crores of rupees. Well, total funds are to be included in this capital adequacy ratio. Now, if you see the balance sheet of a bank, you will find that there are several types of reserves which the banks have to maintain. First is the statutory reserve, and here we find an effort has been made to increase statutory reserve. Statutory reserve means the reserve, the capital fund, the reserve fund, which the banks are required to maintain under Section 17, subsection 1 of the Banking Regulation Act. This section provides that banks should transfer at least 20% of their profits to the reserve fund before declaring a dividend. Reserve Bank of India increased this 20% to 25% sometime back in the year 2001. Reserve Bank of India can exempt the banks from transferring profits to the reserve fund when it finds that the reserve fund is now quite sufficient, keeping in view the liabilities of the bank. But the Reserve Bank of India has not granted such exemption so far.
Just one
Yes.
query.
Yes.
If the amount of reserves is too high, is it a good indicator for the banks? Or
Yes. Yes.
But
It is a good indicator because it sounds the financial soundness, financial position of the bank. Total funds comprises of reserves and paid up capital. Banks have not been able to increase the paid up capital to a large extent, but they have accumulated reserves. The reserve means the owner's funds. The owned funds provide a protection to the depositors. This is the main point.
okay.
Now, in order to encourage the banks to augment reserves, Reserve Bank of India prescribed in May 2005 certain eligibility conditions for declaring dividends, and has also prescribed the quantum of dividend which they can declare. The point is this, that banks shall have to fulfill these requirements before they dispose of their profits in the form of dividends. First requirement is, first eligibility condition is that the CRAR should be 9%, at least 9% for the preceding 2 years and for the year for which dividend is going to be declared. That is, CRAR should be at least 9% for the 3-year period continuously, and NPAs should be less than 7%. Non-performing asset should not exceed 7%, less than 7%. If a bank does not fulfill the first condition for the 2 years, but for the current accounting year for which the dividend is due declared, it is having 9%, then it would be eligible if NPA is less than 5%. The level of NPA is reduced in this year. Second condition is that the dividend should be paid out of the current year's profit only, not out of the retained profits or not out of the reserves. So we find that Reserve Bank of India imposed these three conditions, eligibility conditions on the banks before they could declare the dividend. How much of the profits they can distribute? This is also prescribed by the Reserve Bank. This is called payout ratio. How much of the profit can be distributed, dividends and earnings ratio. It should not exceed 40%, excluding extraordinary profits or incomes. So whatever profits you earn, just 40% you can distribute among the shareholders. Rest of the profits you shall have to transfer to the reserve fund, and in this way the banks shall have to augment their reserve fund, and reserve fund is one of the components of the own funds. This is the reason why, as I told you, the banks have accumulated so much of reserves while the paid up capital has not been augmented to that extent. This is the first reserve, which is called statutory reserve. Then we have got a capital reserve. Capital reserve means on sale of capital assets, banks earn profits, and these profits are capital profits, and these capital profits cannot be mixed with the revenue profits, or the revenue cannot be transferred to revenue reserves. One component is revaluation reserve. When the valuation of the assets of the banks increases, banks can revalue their assets, and whatever appreciation is earned by the banks by way of higher valuation, they can transfer to the revaluation reserve. We find that recently, it was reported in the press, Reserve Bank of India has issued a circular to the banks that they should explore the possibility of revaluing their assets, and the appreciation in the value of the assets should be transferred to the revaluation reserve. In this way, their capital funds will be augmented, because the Reserve Bank of India has noticed higher, or we can say significant appreciation in the value of properties, assets, real estate, especially in capital town of Bombay, where the head offices are located. Many banks head offices are located. So in this way we find that effort has been made to value the assets, revalue the assets, and whatever appreciation is earned by them, the appreciation is to be transferred to the revaluation reserve. And the revaluation reserve is taken at a discount of 55% for the purpose of capital adequacy norm. Third is share premium. As I told you, the banks which issued the share capital, equity capital recently, they charge very hefty premium for the shares. So that premium will be transferred to the share premium account, which will become a part of the reserves. Then we have got what is called investment fluctuation reserve. Investment fluctuation reserve has been created by banks at the initiative of the Reserve Bank of India. You know, the values of investments fluctuate because of changes in the interest rates, or because of the changes in the prices also. So Reserve Bank of India insisted that banks should create a investment fluctuation reserve at least equal to 5% of their investments in two categories, held for trading and available for sale. I will tell you later on that the investments are to be classified into three categories: held to maturity, held for trading, and available for sale. So for the last two categories, whatever investments are held in these two categories, banks should keep 5% of the value of such investments as investment fluctuation reserve. This category can go up to 10%. One can create a reserve of 10%. So this category is included, this reserve is included in the capital reserves, in the revenue reserves. Reserve Bank has also suggested one thing, that those banks which maintained CRAR for credit and market risks for both the categories as on 31st March 2006, they would be permitted to treat the entire balance in IFR as Tier 1 capital. The point is this, that the investment fluctuation reserve is a component of Tier 2 capital, because it is not a free reserve. Only free reserves, the reserves which are not meant for any specific purpose, they are included in Tier 1 capital. Now the Reserve Bank of India has permitted those banks which have got capital adequacy norm, which have achieved capital adequacy norm of 9%, which is equal to both credit risk and market risk. They can transfer this investment fluctuation reserve to Tier 1 capital also. In this way, when these reserves are transferred to Tier 1 capital, the consequence would be that on this basis they can raise further Tier 2 capital. As I told you, that Tier 2 capital cannot exceed to a Tier 1 capital. So when Tier 1 capital increases, naturally banks are permitted to raise Tier 2 capital also to that extent.
Meanwhile, I would like to remind our students that if they have any queries, they should keep sending us their questions so that we can answer those questions. Continue. Sir,
Last point. As I told you, banks are permitted to issue preference shares. But recently, that is in January 2006, Reserve Bank of India has permitted the banks to raise additional capital through new instruments. Reserve Bank of India has permitted 4 new types of instruments. 2 are in the nature of debt instruments and 2 are in the nature of preference shares. I will just briefly discuss the salient features of these instruments. Innovative perpetual debt instrument. The word is perpetual debt. Perpetual debt means it is forever. This perpetual debt instrument can be raised up to 15% of the total Tier 1 capital. This is the requirement. The limit is there. Maturity is perpetual. Perpetual means it is never to be repaid. It will be superior to the claims of the equity shareholders and subordinate to the claims of other shareholders. This is the point, that it will be superior to equity but inferior to all other claims on the bank concerned. Foreign currency, it can be issued up to 49% of the eligible amount in foreign currency also, and foreign institutional investors and non-resident Indians can contribute up to 49% and 24% of the issue, subject to each individual contributing not more than 10% in case of FIIs and 5% in case of NRIs. Interest due will not be payable and will not accumulate if CRAR is or will be less than minimum prescribed. Interest due will not be permitted. The interest will not be permitted if this capital adequacy ratio goes down. CRR and SLR not applicable to these bonds. Put option not available. Call option available after 10 years with the permission of the Reserve Bank of India. Step up option only once in conjunction with the call option after lapse of 10 years and not more than 1% point. Step up option means the rate can be increased after 10 years but not more than by 1%. Call option means Reserve Bank, with the Reserve Bank approval, this can be applicable. After 10 years, put option is not available. So these are the important conditions of perpetual debt instruments, which will belong to Tier 1 capital. Tier 2 capital, debt capital instrument, it will belong to Tier 2 capital. Up to 100% of the Tier 1 capital can be issued in this form. Minimum period prescribed is 15 years. It will be superior to the claims of investors in equities, shares and other Tier 1 capital, but subordinate to the claims of others. It can be also issued in foreign currency up to 25%. Investment by FII is also permitted up to certain limits. And about interest and principal on redemption will be deferred if the cumulative would be cumulative if, for interest if CRR is less than the minimum. Here also the interest would be deferred, but it will be cumulative. It will go on accumulating if the CRR is lower than this prescribed minimum. CRR will and SLR will be attracted. Attracted means CRR and SLR requirements will be applicable. Put option not available. Call option again after 10 years call option, and a step up option again the same condition applies, only once in conjunction with the call option. So
this was the conditions for the preference.
Yes, these are the conditions for the debt instruments, which have been declared by the Reserve Bank of India. There are two other are perpetual non-cumulative preference shares and redeemable cumulative preference shares. These two types of shares are preference shares, and guidelines have not yet been issued on this point. These two, in case of these two shares. These are the four instruments which the Reserve Bank of India has permitted the banks to issue to augment their capital funds. In this way, I have tried to explain to you the efforts which have been made by the banks to augment their capital funds and the extent to which they have been able to achieve the capital adequacy norm.
With this we come to the end of this session, and we'll be back with you at 12 o'clock for our next session. Till then, stay tuned.